The WNA Global Equity Composite was established in 2016 and has been compiled from the returns of all non-taxable accounts over $1 million with a 100% equity objective. This is a new composite that was previously marketed by WNA. The following accounts are excluded. 1. Any account that contains unmanaged assets. 2. Any account that is under $1 million. These accounts are added to the composite at the end of the month that the value meets or exceeds $1 million. 3. Any account that is not invested in accordance with the WNA Global Equity Model, i.e. large cash positions on new accounts, addition of non-equity components, etc. Accounts remain in the composite until asset withdrawal reduces the value under $1 million, unmanaged assets are brought in, or the investment objective of the client is altered. Past performance for these accounts remain part of the composite, and the account is withdrawn at the beginning of the month when the change occurs. The net returns listed reflect the actual management fees charged to the composite accounts. These fees vary according to the account size and fees paid for related accounts. The net return also reflects the reinvestment of dividends and other earnings in the composite accounts, whether as cash or in the original investments. As is the case with all investments, the potential for profit is accompanied with the possibility of loss. A description of the equity indexes listed for comparison in the table provided in the presentation are provided herein. The S&P 500 is considered a broad index for the equity market, seeking to represent the returns of the top 500 publicly traded companies. The MSCI EAFE is a market capitalization weighted index, maintained by Morgan Stanley Capital International, MSCI, which includes a selection of stocks from 21 developed markets, but excludes those from the U.S. and Canada. The Russell 2000 is a small-cap stock market index of the bottom 2,000 stocks in the Russell 3000. It is the most widely quoted measure of the overall performance of the small-cap to mid-cap company shares. The MSCI Emerging Markets Index is a market capitalization weighted index maintained by Morgan Stanley Capital International, MSCI, designed to measure the equity market performance across 23 emerging markets, EM. The MSCI ACWI Investable Market Index represents more than 9,000 securities across large, mid, and small cap size segments, and across style and sector segments in 46 developed and emerging markets. The WNA Global Fixed Income Composite was established in 2016 and has been compiled from the returns of all non-taxable accounts over $500,000 with a 100% fixed income objective. This is a new composite that was previously marketed by WNA. The following accounts are excluded. 1. Any account that contains unmanaged assets. 2. Any account under $500,000. These accounts are added to the composite at the end of the month that the value meets or exceeds $500,000. 3. Any account that is not invested in accordance with the WNA Global Fixed Income Model, i.e. large cash positions on new accounts, addition of non-fixed income components, etc. Accounts remain in the composite until asset withdrawal reduces the value under $500,000. Unmanaged assets or non-modal assets are added, or the investment objective of the account is altered. Past performance for the accounts remain part of the composite, and the account is withdrawn at the beginning of the month when the change occurs. The net returns listed reflect the actual management fees charged to the composite accounts. These fees vary according to the account size and fees paid for related accounts. The net return also reflects the reinvestment of dividends and other earnings in the composite accounts, whether as cash or in the original investments. The composite may or may not be the actual allocation determined to be appropriate for any individual client, and a client may or may not follow the composite. Clients with the allocation shown may have different results based on capital flows, timing of rebalancing decisions, fees charged, or other factors. As is the case with all investments, the potential for profit is accompanied with the potential of loss. The index used for comparison is the Barclays Capital Aggregate Bond Index. It is a broad-range index that represents the total return of the bond market. It covers most U.S.-traded bonds and some foreign bonds traded in the U.S. The index information is supplied to WNA by a third-party quotation service. Investors should note that investments cannot be made directly into this index. The Leuthold presentation is not a solicitation or offer to buy or sell securities. The Leuthold Group, LLC provides research to institutional investors. It is also a registered investment advisor that uses its own research, along with other data, in making investment decisions for its managed accounts. As a result, the Leuthold Group, LLC may have executed transactions for its managed accounts and securities mentioned prior to this publication. The information contained in the Leuthold Group LLC research is not, without additional data and analysis, sufficient to form the basis of an investment decision regarding any one security. The research reflects the Leuthold Group LLC's views as of the date of publication, which are subject to change without notice. The Leuthold Group LLC does not undertake to give notice of any change in its views regarding a particular industry prior to publication of their next research report covering that industry in the normal course of business. The Luthold Group LLC may make investment decisions for its managed accounts that are inconsistent with or contrary to the views expressed in current Luthold Group LLC reports. Wheaton Investors LP, Wheaton & Company LP's parent company, owns 22% of Luthold Group's securities. A managing director of Wheaton & Company LP is a member of the Luthold Group LLC Board of Directors. Wheaton & Company LP, member FINRA, NASDAQ, and SIPC.
So I stood before you all last year basically reflecting on 2014 a little confused in that I didn't think that the market returns that investors enjoyed, at least in the S&P 500, were necessarily justifiable. And as such, I didn't really share the enthusiasm of other strategists going into 2015. My premise, as you may remember, is that a strengthening dollar may have been good for U.S. stocks in the short term, but that ultimately it would be problematic for U.S. stocks longer term. And just to make that clear, 2015 ended up being the worst year for investment returns going back to 1937. Now, I'll qualify that. So stocks globally were down about 2% and change. Bonds globally were down about 3% and change. Hedge funds didn't make any money. They were down 3.5%. And then commodities, somebody asked me about them earlier. You know, the way you correct commodity prices is by correcting commodity prices. They were down 25% last year. And so really there was nowhere to make money other than burying it in cash, where you made 0.1%. So round of applause for those of you who buried it in cash, made 0.1%. It's been a very difficult environment. But basically our thought is that 2015 and returns so far in 2016 have been a give back for what I said was kind of the unjustifiable returns that we got from the S&P in 2014. And so going back now all the way to December of 2013, the Dow Jones Industrial Average hasn't really gone anywhere. So that's been about 27 months, also known as 800 days of your lives. You've been opening your portfolio statements and have seen basically no change. Now, that can, of course, create some investor anxiety, maybe some distrust in markets overall, maybe even some concerns about your financial advisor. Hopefully you don't have those. But fear not, there are ways to overcome this. We just have to work a little harder together to generate alpha. Now, that's our theme for the evening. So let's define what alpha is. According to Investopedia online, alpha is the mathematical estimate of a security's return when the market as a whole is zero. Said another way, it's the return you receive in a return-free environment, an environment that we're currently in and have been in for quite a period of time. So how does W&A go about trying to help you find alpha when the markets aren't cooperating? Well, in our business, and we're continuing to refine our process, and we hope continuing to improve, and we'll, of course, survey you and ask. But there are three main gauges that we look at when we think about how to create alpha for you all. The first one is financial planning, and obviously we've invested a lot in the capabilities of our staff, and I am so proud of the capabilities we have and the caliber of our staff. But we need to get budgeting right. We need to get asset allocation right. There are plenty of things within financial planning that we need to get right to generate alpha for you, and we're going to explore that. We need to be able to generate alpha on the asset management side, and that includes security selection and risk management and all the things that go along with making an asset management program function and perform the way that we want it to and expect it to. And then communications is a big part of this game too. I mean, there's a reason why we send out a Friday email. There's a reason why we have these events. There's a reason why we have a deliberate cadence to meeting with you, our clients. Communications is a big portion of how we generate alpha. And so we're going to spend time tonight exploring each one of these and hopefully get you confident and comfortable that even if the market goes sideways, your net worth doesn't have to. All right, let's start with asset management and look at our 2015 predictions. And so we'll grade ourselves, and then we'll also look at our returns and then we'll move on to 2016 and get a sense of what we see in the economy and also what we expect from markets. All right, this time last year, we told you to expect circus acts from central bankers around the world, specific to monetary policy and also to currency management. Well, that definitely was the case. So I'll run you through the three main regions. First, in the United States of America, we actually stopped printing money. Remember, we did that at the end of 2014. And for 2015, we talked about raising interest rates. And then in December, we actually raised interest rates a little bit. So what happened? Well, the US dollar actually appreciated about 10% against world currencies. The US economy flatlined from a growth perspective, and the local stock returns for US investors were flat as well. Well, in Japan, the Japanese yen only depreciated about 1%, but their continuous stimulus effort there actually did goose GDP. And so they picked up about 60 basis points in growth. And if you lived in Japan and invested in Japanese stocks, if you were a local investor, you were up about 10% last year. In Europe, the euro declined 10% against the dollar. The Europeans did reinitiate their quantitative easing process mid-year last year, so they printed money. Their GDP number went up. And if you were a European investing in European markets in euros, you actually had about an 8.5% rate of return last year. So the US monetary policy exported economic growth and investment returns abroad. Aren't we generous? All right, so even still, we expected that all of this might create a volatile environment, but that equities might work through that volatility and go a little bit higher. If you look at the markets, this is the S&P 500, which is what you all are familiar with. And you can see on a monthly basis, up, down, up, down, up, down, up, down, down a lot, up some more. By the end of the year, the price return on the S&P was actually negative, 70 basis points. If you add back dividends, it ended up being slightly positive on the year. So I'll give us a check mark on that call. In terms of size, we expected that nervous investors would look for comfort in larger companies over smaller companies. That was indeed the case. This divides 1,500 stocks in the S&P 1500 into really large, sort of large, kind of mid-size, and small. And you can see if you held small stocks last year, it was very difficult. If you held mega cap stocks, you had an okay year. Obviously, a very thin market. And we'll talk more about that in a minute. So big was much better in 2015. Give ourselves a check mark there. In terms of style, we expected that investors would reward companies that were capable of growing their earnings despite a difficult earnings growth environment. And in fact, growth was handsomely rewarded to the tune of 1.5%. So if you were a prescient, growth-oriented investor, you had a good year, especially compared to your value-oriented peers who like to buy assets at a discount. Value stocks, when you look at the pure value discipline, were down about 10% last year. So certainly a growth advantage. In fact, last year was really about FANG. Does anybody know what FANG stands for? This is the audience participation moment. Facebook, Amazon, Netflix, and Google. Basically, that was the entire return for the market last year. Now, it hadn't worked out as well this year, but that's what worked last year. So growth did outperform value as we expected. In terms of international, we expected the internationals that were hedged in their domestic currency would outperform the U.S. As I demonstrated in Europe and Japan, local investors in those regions made money thanks to your generosity. And in terms of U.S. interest rates, we expected rates to be lower for longer. That's been a theme for quite a long time. This is a chart of the 10-year U.S. Treasury yield, and just to give you a sense of scale, at the top is a 3, at the bottom is 1.5, and you can see basically last year the 10-year closed where it started the year, so there's really been no movement in Treasury yields. So I'll give ourselves a check mark there. In terms of bonds, in a low yield environment, it's hard to make money in bonds, and in fact, there was no money really made in bonds unless you owned a bunch of U.S. Treasury bonds. The Fed owns a bunch of U.S. Treasury bonds. How many of you all in here own a bunch of U.S. Treasury bonds? Right? Very few people. If you do, you had an okay year in the bond market. If you owned any other kind of bond, it was a difficult year. So the U.S. corporate bond index was down, TIPS were down, high yield was down, and then emerging market debt down as well. So a difficult year for bond investors. And in terms of the U.S. dollar, we expected it to go higher based upon that differential in central bank policy that I highlighted earlier. And the dollar going up is another way of saying every other currency going down. And if you look at the array of currencies last year, that was indeed the case. Just to give you some examples, as I said, the yen was down about 1%. The Chinese yuan, which you read a whole bunch about, all this devaluation, was down about 4%. The Indian rupee was down. The euro, there it is, down 10. And the currencies that really got punished, back to the commodities theme, are those of commodity-producing nations like Russia, which is a gas station, and Brazil, which is a supermarket, basically. So I'll give us a check mark there. So how about that? They're all check marks. Congratulations. We got 100% on our macro exam. Now, that's the past. Let's look forward. So let's take a look at 2016. And before we discuss the opportunity in the markets, we have to discuss the condition of the U.S. economy. All right. Right now, the way the U.S. economy is constructed, consumers, you and I going out and buying stuff, are 70%. And that 70% is growing kind of rather smartly. And that makes sense, right? The unemployment rate is falling and wages are rising, so you have more consumption power. And as my favorite car dealer in here tonight told me, as gas prices go down, people tend to buy more stuff too. And so consumption is rather healthy right now. 20% of the economy is the government buying stuff. Now, if you remember, post the financial crisis, we went into what was known as the sequester. There was that little shutdown issue in 2011, little debt, rating decrease. But nonetheless, the sequester has ended. And now the government has just issued, Obama put a $4 trillion budget out there. Don't think it'll pass. But government spending is rising again, which is a contributor to the economy. What's been punk and kind of sluggish has been the investment side. The energy investments that we saw as energy prices per barrel were at 110 have fallen like a stone. And so we're not seeing much investment on the energy side, but we are seeing it in houses. And so basically that's a push. So you put it all together and the economy's growing somewhere between 3.5% and 4% domestically. That's pretty good. And enough really to grow jobs and also inflation, which is precisely how the Fed sees it. So right now the unemployment rate has fallen below 5%, which is basically the Fed's mandate. And they believe that inflation will climb back to their 2% target. And since both of these conditions are being met, the Fed decided in December of 2015 to raise rates for the first time since 2006. But not only did they do that, they projected that they would raise rates 4 times this year and 4 times next year. And that changed things considerably in the market. The Fed went from being a stimulative agent to being a little bit of a suppressant, and that was a major change, which also disrupted markets a little bit and created what I call the unintended consequences. So the intended consequence of the policy was, again, to suppress inflation threats. But the unintended consequences of the policy have been myriad. And so let me just kind of walk you through. So you have this nice little graphic. You have the first rate hike hit. And what happens is the dollar strengthens, okay, because everybody else remembers cutting rates. Now, the dollar, don't let anybody tell you that it's no longer the world's reserve currency. It is. It is 60% of global currency reserves. And it's 50% of all the transaction volume that happens on the planet. It is the biggest financial asset on the planet. And within an 18-month period, it went up 25%. That's disruptive. What did it disrupt? Well, U.S. trade, for instance. So here's a chart that shows you U.S. exports during the strong dollar period. And as you can see, they've fallen like a rock, which increases our trade deficit. And it also slows down GDP growth by about 1% annualized by some estimates. Well, if you have less trade, you probably have less earnings for those who participate in trade. Well, 60% or so, or 50%, I guess, of the revenues within the S&P are basically generated overseas. And a 25% raise in your currency means you just raised your prices 25%, which makes people go shop other places like Japan and Europe. Goldman Sachs did a study and said of large U.S. multinationals, how big a hit did they take in revenues based upon the strong dollar? And I was even astounded at this. It was about a 7% decline in revenues. Well, if your revenues are going down 7%, your earnings probably aren't going up. And so you look at this strong dollar period, and you can see on the right side that earnings for companies in the S&P 500 have been declining and actually ended up being negative for the entire year of 2015. China. China and the U.S. are very closely related. And China pegged its currency a long time ago to the U.S. dollar because we are their dominant trading partner. And so when we started raising rates and the U.S. dollar started going up, the Chinese yuan went up right along with it, in fact, even more related to its trading partners. Well, just as I showed you, stronger dollar means lower exports. Lower exports means slower growth. And in China's case, that's led to a currency devaluation. It's led to a decline in their asset markets. It's led to Google hits that say things like, is China going to collapse, right? Because there's debt in China. Now, obviously, I lived there, and so I could spend the next 3 hours on this subject. I have to move on, but if you want to, you could ask a question in Q&A. So obviously, the stronger dollar has been a challenge for China as well. What about commodity prices? Well, the dollar and commodity prices are inversely related. This is a great chart, I think, on the left. You read a lot about the supply and demand imbalance in oil, and that's correct. But when you chart the price of oil and the price of the U.S. dollar, they're almost identically inverted. So you can see as the U.S. dollar strengthened mid-2014, that was when oil prices collapsed. So yes, there's supply and demand issues, but there's also currency issues as well. And just to show you that it's not just oil, chart on the right is commodity prices overall, and that's the softs, the hards, the precious, and you can see they've all been hit very significantly. And because countries like Brazil within the emerging markets and Russia are nothing more than commodities exporters, that's created stress within the emerging markets, which has led to currency devaluations and capital flight, right? And remember, money is the oxygen by which an economy's heartbeat is driven by. And so that's made it very difficult for the emerging markets economies to grow. So you add that all together, what seemed like a subtle shift of the U.S. Fed raising rates 25 basis points and going from a stimulus policy to a normalization policy. But really what happened is that the unintended consequences overwhelmed the intended consequences. And that's what's created so much market volatility. The volatility this year has been crazy. All right, so our theme for 2016 now will be world leaders and policymakers now are going to have to tend to the unintended consequences, which means the Fed can't raise rates like they really want to raise rates. It means that the People's Bank of China has got to manage their currency market, which they are doing. It means that OPEC has to come together and manage production expectations. And lastly, it's an election year. We need a legitimate economic growth policy out of the United States of America. So it's time for policymakers to put a shoulder to the task because the unintended consequences have run the table. All right, so with that, let's make our predictions. So we predict that for 2016, which may surprise you, the market will be higher from here. You know, doesn't necessarily mean it's higher on the year. I actually wrote that on February 12th. Right? And I think the market was down about 10%. Doug, you know this probably by heart, but I think it was down 10% or so from there. And we got a little 5% rally, so far we're in the black. So I'm saying higher from February 12th. All right, in terms of size, I mean, that's about as, pessimistic as I can get, so come on, cut me a little slack. In terms of size, we still think people are going to feel comforted by the blanket of large companies over small. In terms of style, there has been a dramatic, and Doug's going to show this in a minute, a dramatic drawdown in asset prices, and many babies have been thrown out with the bathwater, the bathtub, the sink, the tile. And so that's created opportunities for value sleuths, maybe to outperform their growth counterparts. And in terms of domicile, the selling in emerging markets has been extreme, and it's been going on for a long time. And it may be that the selling is just kind of getting exhausted. And so we think maybe the emerging markets find a bottom in 2016. In terms of U.S. interest rates, I think they go lower because we've got negative interest rates in Japan, we've got negative interest rates in Europe, and so they are really determining what our translation interest rate can be, and because of their depression, that'll be lower. In terms of bonds, we also think that there are value opportunities in bonds. We don't think we're going into recession, and because we don't think we're going into recession, those bonds that have been priced for recession are probably good bargains. And in terms of U.S. dollar, please, God, please have the Fed and give them the wisdom not to take the dollar any higher from here. And there's our primary threat. It's Bernie Trump. I say this tongue-in-cheek, but I really mean this. Since the global financial crisis, the central banks have had to do all of the work because Washington economically has been useless and totally dysfunctional. And so what we really need at this point in time is some economic leadership on the fiscal side of the equation. It can't just all be about central banks, and they're kind of running out of bullets. And so this is really no time to be clowning around, even though we're having fun watching these two guys.